Today we're going to talk about M&Ws and peak formations. Probably one of the most important videos that you can watch. Stay tuned, traders. We'll be right back. Good day, traders. Stacey Burke from Stacey Burke Trading. It's the weekend. Time to review, go over what trades you took this week, revisit them, study what you did well, what you could have done better. Maybe if you had some best executions or how you could have executed better. All the little things that can be deconstructed back to how you're going to recognize and perform better in live time this week. Because we know there's going to be 50 pips probably every day in at least one of the sessions, and we're going to see some of the same textbook setups. Today we're going to talk about peak formations, and peak formations are, I think, probably the most critical part of the entire trading process, because aside from risk management, of course, but peak formations allow us to form a bias, whether we're already in an existing trade, to recognize when that trade may be expiring or potentially reversing or continuing, especially as we head into the next session, the next 12 candle window. Almost every single day we've had a textbook perfect setup. We're going to see the same stuff next week. It may be on the Aussie dollar, it could be on the pound Aussie, it could be on the pound yen, it could be on the Swiss franc. But if you understand the peak formations, you'll understand when they flip the book or reverse the market. So they're taking traders down low, and all of a sudden they're working the low and putting peak formations into the low for the reversal back in the New York session or at the end of New York, whatever that may be. But even in the rollover, Monday, Tuesday, Friday, Monday, Tuesday, the high and the low for the week, that establishes our initial balance. There's a peak formation up top, there's a peak formation down below. That establishes, are we in a trending market? Are we inside? If we're inside of the high and low for the week, are they putting any peak formations in place for potentially retesting the low or retesting the high, working up high, trapping volume up high, and then shifting the market, or breaking through and then working down for the continuation? All those little things. But almost every day, if you understand the peak formations, you can start to identify or create a thesis, a bias for either buying low, selling high, and it can be a breakout pullback. You're still buying low with the trend or selling high with the trend. We talked about the three types of M&Ws. Today we're just going to go a bit more in depth into the peak formations, because if you really understand those, that's what will help cement, like Friday was a great example. Peak formations in place from the beginning of the day, and they drag traders, just that slow, continuous movement. There's no volatility, no reversal heading into the US session. Traders are waiting for the reversal, but we haven't had that, because they're just continuing dragging it into the close, maybe stop hunting at the end of the day into traders who have got in late into the US session. But no peak formation. So as we see the peak formation set up, sometimes we'll see the high of the day in Asia. Sometimes we'll see the high of the day set up prior to getting to London, or the low of the day set up prior to getting to London. And that's what's important. Monday, Tuesday sets the initial balance. Just to review, okay, we'll talk about the news in a second, but 15-minute charts, 8 to 11 p.m., 2 to 5 a.m., 8 to 11 a.m., New York Eastern Standard Time. That's the 12 candle window. Yes, we can get movement prior to that or after that, but generally speaking, that hour in the middle of that 3-hour window is when the equity markets open, and there will either be a trap or a trade. Very critical to understand that. The next most important thing is when that middle hour opens, have we already had a stop hunt? Or will they use that equity open to stop hunt the high or the low for a reversal or a continuation, trapping traders in the wrong direction before they shift the market to either continue a trend or reverse it on a squeeze or a 3-push pattern, whatever you want to call them. So we talk about structure, geometry, rectangles, ascending triangles, descending triangles. But most importantly, if we're later in the week, do we have a high a low of the week in place? Are we up high? Is the market jamming in up high, or have we broken out of a previous week and jamming in for a continuation, whether it's a long or a short? But geometry is critical because that helps us identify potentially measured moves for more than 50 pips. So you might be selling high for 75 or 100 pips. After, Asia, London, New York, selling high or buying low, whatever that may be. But measured moves with bigger geometry helps us target bigger profits. And now obviously if you're in a winning trade, we want to squeeze as much out of a winning trade as we can with still maintaining our 1 ATR, our 1 bar stop where we enter the market. Then we talk about the high and the low of the day. So peak formations, and we're going to go in depth a bit more into that. The timings, the 12 candle window. We've talked before about 717 and 915. Okay, the hour prior to the 12 candle window, sometimes we'll see a stop on occur, or movement 1, 2, 3 to an extreme, to the high or to the low. 915 is when the 4 hour, the 1 hour, the 15 minute, and the 1 minute all roll over at the same time. So people ask, do you use multiple time frames? I don't. Right or wrong, I don't. I just feel like mastering the 15-minute chart, and when I review my perfect trade setups, I know exactly what I'm looking for. I'm using multiple time frame analysis, right or wrong, I don't do it. I look at the dailies for specific, Monday, Tuesday, Wednesday, Friday, Monday, Tuesday type setups at the highs and lows and the beginnings of the month. The beginning and the end of the month are rollover times. Maybe they lock the book in, we got options expiries, we have all these other things with futures contracts. But typically I look at the high and the low, always the high and the low of the month, and the beginning and the end of the month in terms of stop hunting a previous month's high or low or continuing a move. Then we talk about round numbers, and we're going to talk about a bit more about this today. The 50 pip box, the peak formations, and identifying the 50 pip box as you head into the next day based on the peak formations that are already in place. So just to clarify, these are all the steps that I use to go to the screen each day in live time. So people can say, you're looking back at old trades. No, we're looking at what we're going to do in live time. So we're deconstructing this in a step-by-step manner to take everything down to the 1 or 2 bars that are going to confirm things right down to the 12 candle window. Okay, and we've even talked about this before. Most of those trades are going to be the first or the last candle of the hour, and sometimes it can be the second candle if it's at the extreme, like the London Open 10-15, buy low or breakout pullback continuation. But generally speaking, it will be the first or last candle of the hour. So now we're down to 6 candles. So engulfments, pin hammers, now we're down to basically 2 candles. So out of that 6, we're looking for 2 candles at the high or the low of the day or the session. 1 bar stop, profit target typically is going to be 50 pips minimum, unless we hit round numbers with a higher low of the day, and that'll usually be around the 40 pip mark if it was to expire prior to fulfilling our profit target. And I've talked about this before in the rules. You can go and download them. If it goes sideways for more than 30 minutes at 40 pips without hitting the 50 pip target, I'll look to just close the trade out. Even if it moves, I'm okay with that because I make decisions in live time. I live with them. Sometimes I make the right one, sometimes it kept going. But if it goes more than 30 minutes after moving within 10 pips of my profit target, I'm going to lock it in. Okay, so then we talk about self-management and trade management. The more you focus on some simple playbook setups, whether they're squeezes down low, squeezes up high, M&Ws at the high of the week, the low of the week, or the day, trend continuations, breakout pullback, engulfments, pin hammers, into the next session or into the beginning of a session. Just whatever those things are that you pick out best. I think I'm naturally bearish by nature. I tend to recognize sell setups a lot easier. Getting better at the buy setups. I have some trouble with some trend trading sometimes, but that's getting easier because once you've been burned enough, you start to recognize the same 2 or 3 setups that show up over and over again. Screenshot your charts, print them off, master the basics, understand where those trades can be recognized, and hopefully today that will help clarify some of that stuff. Trade management, again, just letting the trade, once you've done everything right in terms of your process and you've executed, you know, who knows what the market's going to do? We don't know. I'm not here to predict, we're not here to do anything else, but we're looking to identify the setups that we've classified as our best playbook setups. We take an entry, we manage our risk, we put a profit target in place, we let the trade do what it's going to do. And then 90% of the time when I leave that trade alone, you know, it ends up usually being a fairly good setup. When I try to micromanage the trade or finesse it or optimize it, that's when I run into trouble. I get out too early or I hold on too long. You know, I average into a trade that's expiring, or I don't put enough size on a good trade, or I have little size on a you know, huge trade, and too much size on a low quality trade. But again, the longer you see these and over again, you just start to filter out the crap and narrow it down to the 2 or 3 setups that show up every single week. So just coming back to looking at, you know, the types of bars, okay? So we've got a bull candle, a bear candle, a doji, inside bull, inside bear. We got a bear pin reversal, a bull pin reversal. We got a bull pin bar and a bear pin bar. Those are basically the majority, you know, forgetting outside bars, these are the same thing. These are effectively end of day candles. So these are the variety of price action that are going to occur over the 3 sessions, Asia, London, and New York. At some point, we're going to get a high. We're going to get a high of the day in place. And at some point, we may get a low. Okay? So, just as an example, Asia may put a peak formation in place and drop down and work into the low as we head into the Europe-London 12-candle window. The market will work its way down, makes a new low, makes a new low. Traders are trying to counter trend this, and it's important to understand that this isn't a peak formation low. This is just a pullback in a down move. The reason why this would be a peak formation high is because the market has broke below and worked into the low before shifting. And they may even come up here. So we've talked about the type 2, and we've even talked about the type 3, which is up top. But when they're working into the high, and that can even be on 3 pushes, okay, when they work into the high, we're getting near potentially the end of the move. If they work into the high and then come down with 3 pushes for a retest of the high, which we'll often see heading into the US, we'll see 2 peaks and then 1, 2, 3, boom to the high, and then we'll see a reversal up top on that 3rd leg. But generally speaking, this is a downtrend until we see them put a middle structure in place into the peak formation low. So we need to see a breakout pullback. So traders are holding on to this thinking it's going lower. They put a middle structure in place. Next thing you know, they work into it and the market's taken off for the reversal. Okay? Now the difference is that if this was a down move, we could see this moving down. They put a middle structure in place. They come down again and work the low to continue the trend. We're going to look at some peak formation lows and some peak formation highs as the week evolves. And I want to talk about understanding when we have a high of the week and a low of the week in place, how each day we can manage or have a bias about where we're at based on where those peak formations are. So if we have a high of the week in place, well, whatever we want to do, and we have a low of the week in place, however that may present, could even be this. If we open up somewhere in here on a Wednesday or a Thursday, doesn't matter, we're inside. So at some point we have to wait for this market to give us some indication of peak formations, whether they're working the low for a continuation long, or if they're working the high in 3 peaks for a move back down towards the low of the week. Because we're gonna go back up at some point to either retest the high or retest the low. So when we're inside, we need to wait for the market to either sell high or buy low with peak formations. So we could see Asia, London, New York for a sell high in the middle of this range, Or we could see, as we saw before, 3 peaks. We've talked about descending triangles back to the low of the week. Or we could see a consolidation in that upper quarter at the high of the previous day for the trend trade to continue through the high of the week. We talked about initial balance Monday, Tuesday, Friday, Monday, Tuesday, setting the trading range for the week. Every day after that, once we have our initial balance from the high and the low of Monday, Tuesday, we can have a bias based on that and the peak formations that show up. So if we look at each day, if Monday opens up and takes out a previous day's high, or they push into a peak formation from Friday or Thursday, whatever, if they're extending the range up as we head into the Europe Open, chances are they're setting up for a sell high setup. If not, we'll get a 1, 2, 3 in the Europe London Open for a continuation long. But if they extend it and put a new high in place in Europe, pull it down, you can guarantee that London's probably going to hit it one more time for the reversal up top. And the same thing applies for the down low setup. If we get a consolidation at the low of the previous day and they're working the low, okay, we're going to get the engulfment pin hammer for the breakout pullback continuation long. It's always about trapping traders in the wrong direction, shifting the market at the extremes. But when the high and the low of the week have been established, each day the peak formations help us create a bias for either being jammed in up high and having a reversal, or a breakout pullback jamming in against the trend for the continuation long. We're going to look at some examples on the charts, but hopefully this will clarify things. I know traders are hanging sometimes for the reversals, or they're looking to, catch a falling knife. Let the market give you the information that you're going to need to either enter in with the trend or the blow off, or wait for the market to give you an indication that they're trapping traders in the wrong direction, jamming them in. They flip the book. Okay, so if you see the middle structure is this. If you're going higher, at some point the last low before the high is going to get broken. Okay, once they break that, now you've got a middle structure for a measured move in the opposite direction. Now you can certainly get the last low before the high and then a reversal above that. Okay, so you've got your M and W formations, but if you understand when you're occurring, we talked about 25, 50, even 75 pip extended moves. Every time the market moves 25 pips, start paying attention to how the price behaves when it arrives at that level, and then the timings. If it's outside of our 12 candle window, they may not be done yet. Wait for the market. If you're at a high or a low before we head into the equities open, they've either already jammed traders in and they've reversed the market, or they're going to pull it back in that first hour or second hour to revisit the extreme on a stop hunt or a continuation. So hopefully you'll get some value out of today's video, traders. Again, thank you for all the great feedback, a lot of great feedback about the great debate. Thank you to Pepperstone for providing that for us. A ton of information. There's some great opportunities with Pepperstone right now. They're offering commission-free trades. And so if you need more information about that, let me know. Send me an email. I can put you in touch with my broker. They've been fantastic. But that's a great way to get started. And also, the questions, keep them coming. I appreciate it. Thank you for hitting the like button. Every week, 1% better. Keep it simple. Stay focused. Keep getting better. And may the markets go with you.
Good day, traders. Stacey Burke from Stacey Burke Trading, continuing our discussion on the M&W formations and the peak formations. As we head into the new week, we have a peak formation high in the end of the Friday U.S. close. The market pulls back. We also have a peak formation low from when the low of the day was made. And we have a peak formation low that was established in the U.S. session. As we head into the new day, the market gives us a peak formation high. So this, if you recognize what's happening here, we talked about high bull, low bear. So if we take our high bull candle, the market initially pushes up into the high bull. And this is getting traders to potentially short the market thinking that they're being jammed in. Some traders might take this long. I don't typically trade in this rollover time. The spreads widen, etc. But what happens is, again, just think logically about what's happening here. The market has jammed traders into the peak formation. They, maybe traded the break of the doji, whatever that may be. Or they've shorted it on the pullback. But if we had waited for our 12 candle window, we get a bull pin hammer, right off the start with an engulfment and a bull pin hammer at the beginning of the session. The most important thing at this stage is that if the market takes out this high, then this market continues to trend. If this market was going to reverse, working into the high, working into the high, working into a high a third time, pulling back, trapping traders, shorting this, whatever that may be. We've obviously got swing lows, but we're in an uptrend. So traders that are trying to short this market are shorting into a market that has given us peak formations in place. So this is a pullback at this stage until the market gives us a lower low or a three-push pattern, jamming it in, and an engulfment shifting. But we're talking about that happening into the timings. So we have peak formation low, breakout pullback, continuation, peak formation for a pullback in an uptrend. Market consolidates, we get a bullpen, engulfment, and hammer. It continues through the high, and we get a pullback at the Europe Open. So think about this. Traders short this on the initial engulfment bear pin hammer, but we're in an uptrend. And we always talk about, I had somebody mention to me a few weeks ago, it's contradictory. You'll sell it one time, you won't the other. We're looking for a second leg. That's what gives us our peak formation. But more importantly, it's the timings of when this happens. Okay, the Europe Open takes traders down that shorted early, first mouse, and then the swing long takes traders who are trying to chase the trend long. So all your technicals by this stage are long, whether they're moving averages, stochastics, RSI, CCI, whatever they may be. Everything's long. Trend lines, the whole deal. We get a second leg, and you'll notice that the small candle is the fourth candle of the first hour. Smart traders actually sell the high, right at the high. Really good traders will sell the high after the breakout pullback. The initial break of the Europe Open is down against the trend, the retail trend. They pull it back to sell high at the London Open. The London Open engulfs with a pin to the high. Okay, so somebody asks, how do you know when you're at the high? Or, what if the candle's bigger? Once they pin the high, they've pinned the high regardless of how big that candle is. If they've locked it in, this is what scares traders out of taking the trade, is they perceive a bigger candle or the risk is increased. But once they're done doing business up there, the majority of the time, they're going to move this quickly because they've got all this volume trapped that they want to stop out and take the money. So if they go back up top, they allow traders to potentially get out of a profitable trade or get out at break even or with a small loss, which is why these markets move, and when they pulse, it makes traders second guess that it's going to be a pullback for a continuation, and each bar that falls, they see their profits erode, and we've all been there before the next thing you know, they're stopped out at break even or even with a small loss. But second leg, peak formation, and we're at the beginning of the week. We've taken out Friday's high, even though we haven't gone up to the peak formation from Thursday. At this stage, we're at the high of the week. The market comes down to the low. So you'll notice we have a type 3 or type 2 debatable. We're at the high of the day with an M formation in the 12 candle window, London Open, first candle of the second hour for an engulfment with a pin to the high of the day. The market, again, we talked about breaking into the upper 25 pip box. The market comes down to the low of the day, pulls back. Okay, this is not a low. This is a low of the day now, but the market is still down until the market jams in and again one push, two push, three pushes into the low before we get the pins flipping to the bottom. And you've got to be paying attention to the timings. It's the timings of when all this happens. They're heading into the New York 12 candle window. Okay, they break out after three pushes, two pins to the low. It's basically, essentially, for all intents and purposes, an engulfment after the third push with pins on the bottom. Breaks out in the third candle, and they stop hunt the high of the day, getting traders who shorted the London Open. So we now have a 1, 2, 3 to the high in our 12 candle window, a shift candle that engulfs the upper two candles, okay, giving us a peak formation high. Again, we're now in a range-bound market. We're not in a trend because we've worked the low, worked the low, worked the low. We had a middle structure, so we talked about middle structure. That's what gives us our geometry. We had a middle structure here, okay, for a measured move, okay. But as I said, okay, this expanded two times the measurement from up top, but also it hit the low of the day. So sometimes these trades may not do a full measured move because they hit the high or the low or round numbers. So we see that the middle structure met one full expansion as well as hitting the high of the day when it reversed off the bottom. But we have our W structure on the bottom. High of the week, low of the week. The market then reverses off the high of the day after a 1, 2, 3 in the end of our 12 candle window. Drops down, consolidates, gives us a type 3M. Again, debatable. People can argue, well, what type 2, type 3, it doesn't matter. There's an M formation and an engulfment mid-move for the continuation down through the low of the day. And as we head into the next day now, we have a peak formation high. We've taken out the low of the day. And what does the market do? It works back up a third time, giving us a peak formation high, okay, but also another M formation. So point being that when you recognize that this may have already occurred heading into Asia, if we have a peak formation high of the day in place in Asia, your bias potentially may be to sell high, or if they move the market 50 or more pips into London, you may be looking for the W reversal formation. But Monday paints the high of the week. We need to be thinking that potentially today on Tuesday, at some point we may get a low of the week in place. They give us the continuation M pattern into the Asian Open. Traders short it. Okay. One push, two push, but they pull back, giving us a little W formation at the bottom of the 25 pip box. But as we head into the Europe-London Open, what do we get? We get a stop hunt back into the peak formation high of the day. They drop it down, so we now know we have a peak formation high of the day, but also a peak formation heading into the 12 candle window. 1, 2, 3. Okay, that's a stop hunt into the peak formation. So they're jamming traders into the peak formation high in a down move. Okay, so they push in and then shift the market. This little bear candle engulfs the inside bar. Okay, they jammed them into the peak formation that was a stop hunt into the peak formation of the day in a down move. Now we have geometry for a potentially measured move of one expansion. So if you're short in this market at the London Open, we're looking for a full expansion to the downside. The market continues the move down, one push, two pushes. Okay, two pushes down. Middle structure stops at the first pin of the first leg down before pulling back, consolidating pins. Traders are taking this long, but what we see is that we have one push, two push, and then we get 1, 2, 3 into the move. Whenever you get two legs and not a third one, and they go three pushes into the trend or against the trend. Thank you for traders who were correcting me that that may not have made sense. I always say into the trend, but okay, against the trend is probably better terminology. One push, two push, three pushes. against the trend, and guess what time it is? US session, 12 candle window. We have a middle structure. That's called an M formation into the 12 candle window. Okay, so some traders may have went long here in the W. But again, as we head into the 12 candle window, you've got to be thinking either this needs to be making new highs, or if they go 1, 2, 3 into the US session 12 candle window, I'm the one who's caught. Because there's stops down below the low of the day. And we've said this before. They're going to go after the money either up top or down below. And if you see a 1 push, 2 push, 3 pushes inside bar, an engulfment with an M pattern, that's a peak formation. Okay, you either need to get out, get stopped out, or be, if you're not short, but that's a 50 pip move down to the low of the day. Now traders, again, if you're short here in the middle of the move, when the market gets down below the low of the day, I take my stops to break even. Paying attention to timings, we're at the second candle of the middle hour, which is also the equities open for New York. We get an engulfment. An engulfment, which is now only a pullback. It's a low in a down move. We've had 1 leg down, 2 legs down, 3 legs down. We get a pin doji. One last move down to the downside on the bear candle. Traders chase the move thinking it's going to be a measured move or a continuation, and then bang, a shift candle. We have a middle structure, we have our W formation, and we also have a peak formation low of the week. We have a peak formation high of the week. We'll put a line up here. We'll put a peak formation low of the week. So now we're heading into the next day's session. We've come off of a peak formation low. The market has taken out the US session high, which was a peak formation high in a downtrend. Okay? We have a peak formation low. The market has broken through that. So we're in an uptrend market until the market tells us otherwise. So our first potential target is obviously the high of the previous day. They take that out in the rollover. So we're thinking high of the week. We head into the next day. The market makes a peak formation high. They extend that higher in the Asian session before pulling back, continuing making new highs. Traders, again, think about what's happening here. The technicals are taking you higher up. They engulf that. Traders short this. We talked about this. They short the engulfment in an uptrend. You're shorting against the trend. We don't have any lower lows yet. These are all higher lows. Okay. Higher lows all the way up. And that doesn't get broken until the end of the 12 candle window when we get our M formation. So we get an M formation. Traders short this. We get to the low of the day. I go to break even every time a high or a low is broken. The market goes sideways. So we gain a 25 pip stop hunt against the trend. The market goes 1, 2, 3 engulfment, reverse bull pin hammer for a move back to the high of the day. We're outside of our 12 candle window. We're in an uptrend. So this is the first break of the trend line. They come back and retest the peak formation highs. Okay, they make a new high, but they only tap it before going sideways and engulfing the upper 4 bars, and the last bar being a bull pin hammer. So just to also pay attention to looking at our peak formations. So the market is starting to give us an indication that it's not continuing towards the peak formation high of the week, but we have a peak formation low and a peak formation high. Now, just looking at 50 pip boxes, so if the peak formation high is up here, we can see this is more than 50 pips. So the first place this market should revisit is the current low of the day, which is our middle structure again. Middle structure. We need a middle structure usually before a market will reverse. But it will target next the peak formation on the opposite side. The market goes the 50 pip move down through the low of the day to round numbers again, 50s and zeros. Goes into consolidation, but not after pulling back and stop hunting the traders who shorted the market. We get consolidation, but these peaks are stop hunting back into the peak. Market rolls over into the next day. It works into the high before giving us an engulfment with a middle structure. So we have our type 1M for the high of the day trade. Comes back inside of our lower middle structure. Pushes down a second time. We get a 1, 2, 3 engulfment, taking traders into the low of the day, but it pulls back inside at the London Open before hitting the high of the day. So we have a peak formation high that's been taken out. We talked about the last low before the high. The last low before the high. The previous day, this was the last low before the high. The last high before the low. Gets broken. Then the market pulls back inside. Stop hunting into the peak formation low. It doesn't take it out. It engulfs on the next candle. Pushes down again into the peak formation low without taking it out. Pulls back again. Consolidates underneath of the middle structure peak formation high. So traders are chasing this. Again, remember, all the technicals are down. All the technicals would be down. All the trend following indicators are down. They're tracing this down. They chase it down, chase it again, or holding on. We get an inside bar, a hit to the high, then a bullpen hammer at the high of the day and a breakout candle. Some traders would have already been long, somewhere in here at the numbers, or up here on the breakout, whatever that may be, but we head into the next 12 candle window, the US session. Our original thesis is the high of the day. If this market continues, we go sideways and we get another inside bullpen hammer. Traders could be looking for, again, the geometry of a measured move. Okay. A couple ways to measure this. We can look at 2 times the box. Typically, I will look at 2 times the high and the low, at least as a minimum target, or we can just look at numbers. So if this was a 25 pip box, we're looking at 50 pips, so 75 pips. That takes us up to the double zeros. It takes out the high of the previous day. But again, talking about peak formations, peak formations are lower. They reverse it and jam into it. So you'll notice now this is a peak formation low. Peak formation low, they have flipped the book. They're jamming them in, and then shifting the market. We have a peak formation high in place as we head into the next day. They put a high of the day in place and then pull it back into consolidation. We have our high bull. Previous day we had our low bear. Okay. We head into the next day. The peak formation is up. They put a peak formation high in Asia up into the peak formation from the previous day. So one of the things I said was don't counter trend the peak formation. You have a peak formation high in place. We have to be thinking, unless it gets taken out, we're looking for a sell situation. Peak formation high, a low of the Asian session. The market goes 1 push, 2 pushes, 3 pushes, inside bar, engulfment on the third leg before dropping down, breaking the low of the Asian 3-hour 12 candle window, pulling back, bullpen hammer, dropping down into the lower 25 pip box before 1, 2, 3 into the low of the Asian session. So we now have a peak formation high. We have a peak formation high from the previous day's session, peak formation high in Asia, 3 pushes into the peak formation for the shorts. We have a peak formation low in a downtrend. Traders have sold this. 1 push, 2 pushes, 3 pushes into the shorts. Okay, still not, they're not pushing down into, they initially stop on into the peak formation low, but then they work into to the high. 1 push, 2 push, 3 pushes into the high to shift it down in the 12 candle window. Not much follow through though. Okay, not much follow through. Market pulls back, hits it again. Okay, so now we potentially may be in a reversal. We've got a 3-bar engulfment at the low of the day in our 12 candle US session, but you'll also notice this range so far is inside of the previous day's high and low. So Friday is an inside bar. Our last shift was a reversal off the low of the day into consolidation. It is currently closed above the last peak formation high. Depending on where we open up on Monday, we could see a retest back up through these peak formation highs. So high of the day, low of the day. London's in the middle. Previous day, Asia opened up slightly down. Drag traders lower into the London Open. They jammed them in before shifting the market back to the high. So each day, think about what's happening. We could get a high or a low of the day in Asia. London could be in the middle. It might be the low or the high as well. And the U.S. session could be jammed in after the fact in the middle, or it could be at the extreme for the reversal in the opposite direction. Pay attention to the peak formations. That was where you will be able to identify your M and your W formations for reversals and for high of the week, low of the week type setups, traders. So hopefully you got some value from today's video. Keep it simple. Keep getting better, but study these peak formations. When they're broken, the trend continues. When they're reversing, they'll start jamming them in inside, or sometimes just to the extreme to pin the high or pin the low after 3 pushes and an engulfment and pin hammer. Have a great weekend. Enjoy yourself. Study hard. Let's make next week even better.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburktrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.